What's up, team? Welcome back to PubGPS, Financial Wisdom on Tap. I'm your host, Brian Emmerich, and today we're talking about my thoughts on the stock market. Specifically, the reactions that it's okay to have when that puppy kind of looks like it's going down like a sinking ship. So let's talk about the first reaction. Say you get an email or you get that envelope in the mail and you open up your brokerage statement. Your first thought is, why is this 27 pages long when so much of it is nonsense? This is killing trees. And your second thought, once you look at the value of what's on there, is it's a whole lot less than what it was last month. And I'm pissed. So let's put that one on the board. It is perfectly okay to be pissed off when your money is worth less than what it was before. I do this for a living. I do this every day. I'm still not cool, calm, and collected. I get ticked. My hard-earned money, which was worth this, is now worth this. And I don't feel like that's just right. It's okay to be pissed. Let's talk about our second reaction that you can have, is you can be nervous about what's going on. Fix that. And it's perfectly okay. Don't let anyone tell you that you should just be calm. It's no reason to be nervous. It's okay to be nervous. There's so much going on in the world that's likely causing the market to drop, let alone what's going on with the market itself, that it's okay to feel a little bit nervous. Let's go over our third one, which is feeling insecure about the stock market. This is where I draw the line. It is not okay to feel insecure about what the stock market is doing. The stock market is a weighing machine that helps you determine the value of that company. It helps you try and predict if that company is still going to be profitable. Is it still going to be generating revenue in the future? And using that information, what is it worth today? If the stock market is going down, it's because those companies are likely not going to be as profitable. The stock market as a function is doing what it's designed to do. There's nothing wrong with it. It's telling you that the company you owned and you liked may not be worth as much money because it's likely to be earning less money in the future. That's not a reason to feel insecure about what's going on. But it is okay to be nervous, and I think it's okay to be a little bit pissed too. So, Brian, what do we do with this information? And here are a couple of takeaways. The first thing that you can do is put new money to work. This is money that you're earning or that's been in the bank account or that's quote unquote on the sidelines that hasn't been invested in stocks. You can look at this as an opportunity to go, I really liked that investment when it was worth $10 and now it's worth $8. I have a chance to buy it when it's kind of 20% on sale. I know it sounds a little bit ridiculous, but you don't wait to buy a car because you think it's going to be more expensive next year. You don't go, yeah, you know what? I kind of feel like it's going to cost more next year. Let me put it off and I wait till then. No, you get to the dealership because you want to get your hands on a good deal. Approach number 2 is you rebalance your accounts. Now what a rebalance might look like is if this is your portfolio and you're 50% stocks and 50% bonds or money that's not fluctuating as much, when the stock market drops, you might go down to 45% stocks and 55% bonds, because of the way the pie is divvied up. Well, when this happens, you have a chance to rebalance and bring everything back into check to get you back to 50-50. And what you've done is you've taken advantage of that buying opportunity. You're using money from the supposed sideline to buy at a discounted price. The third approach that I'm going to leave you with today is to do a negative rebalance. And a negative rebalance means you're taking this approach from number 2 and you're exaggerating it a little bit. Maybe you were 50-50, 50% stocks, 50% bonds. And because you think it's such a good buying opportunity, you go, hold on, let's scratch that for a minute. I want to be a little bit more aggressive now. I'm now going to go with 60% in stocks. I'm going to buy even more than what I had before, and 40% in bonds. The fourth one that I'm going to put up here is if you're really having trouble with what's going on, it's worth a conversation with your advisor to maybe take less risk and just put some of the money that is fluctuating someplace where it might have a little bit less volatility. I think that's okay to do. But if you're looking for the opportunity and you're looking to make wise decisions for the long term and deal with the short term pain, you want to buy the opportunity with new money, rebalance, or even do a negative rebalance. Hang in there. Life is good. The world is good. Thanks for joining us.